Hey guys, welcome to DreamCoin, where we show how to invest for a better tomorrow. My name's Tyler, and today we're going to be doing the first video in a series I'm going to be uploading to the channel revolving around risk management and figuring out how to set yourself up in a better position for your trades. This first video is going to be based around the concept of dollar cost averaging for trading, how you should be looking to enter positions more safely, and how we will be looking at going into allowing for your averages to be able to follow trends when you're getting into even volatile stocks. My next few videos that I'm going to be doing after this are going to be more revolved around setting up your charts in a more advanced way, and then also learning how to exit your positions or just finding better stocks that have more fundamental basis behind them. As we get deeper into the video, we're going to be assuming that we're using $100 in buy power. I think this is relatable for a lot of people, and it also gives a nice round number for us to take flat percentages out of without having to make the numbers too big to follow with what we're looking at. So when I'm trading, I'm usually going to have a strategy that revolves around three different segments of when I'm buying into a new position. The first being my initial buy-in, or where I start my position. The second being small price movements, whether they're up or down, so that you play off of that initial buy-in and follow the trend up if it's going up, or down if it's dipping a little more. And then large price movements, where usually I focus a lot more of that on larger dips, because I don't like to buy at larger percentages as a stock is rising. So two of the stocks we're going to be looking over are going to be CCXI and INFI, both stocks that I have been covering for a while now. I specifically had somebody in the Discord request INFI in this video and where we're looking at for them. But basically the concept is going to be, we're going to be looking at something where it was more volatile on this over the course of a few days versus something like INFI, where it's been pretty consistently in a certain price range for the entire year almost at this point. So to cover the basics, to look how we get into this, we're going to be going over some very basic charting that I feel like everybody should be willing to learn when you are looking to get into trading. Specifically, if you're not looking to fully invest and you're even trying to do swing trading, I think charting can get you very far for where you can at least find peaks and lows that you could possibly be looking at for buying and selling between. For a lot of people, the concept might seem a little scary, but that's why you usually just focus on one thing at a time. And this is why we're going to be going over basics today, such as finding possible supports for you. For me, when you're looking for a support, it's usually a good idea to try to match up not only 2 to 3 separate support points, but also previous resistance, because using a support that also touches previous resistances allows for a stronger foundation of where your price is sitting and a more likely bounce if it does bounce off of that support. The trading for INFI this year is looking to be forming a triple bottom from where it's currently priced at. And if we look at putting a support roughly here where these 3 points have connected roughly, we can see that it does test a sort of resistance area through here, where once it's broke up and got through here a second time, that's basically held for the last year to date on the stock. If we zoom out even farther, you can see even as far back as 2019 and 2018, that same resistance has been a common issue for this stock, pending the fact that they haven't really done too many splits or anything like that. So they are following similar cycles where key support and resistance levels are still being respected as far back as a few years ago. So needless to say, looking at this where we've got a point of 3 different support levels, and then we've got a few different resistance levels as well following up on this, this seems to be what could be a very strong foundation for the rest of the year on INFI. For a lot of people, looking at candlesticks can be a little intimidating. So especially when you're first starting out drawing supports and resistances and different trend lines in general, it's usually going to be a little easier to look at a line chart. I also look at a line chart every once in a while if the candle wicks are kind of just ridiculous from huge volatility and stuff on a stock. And so pulling out these lines gives you more rough edges to kind of line up with your support and resistance. So if we zoom out here and look at that same support area we were doing, and we put the price almost exactly where it's been trading, we got kind of lucky because the price is basically giving you an invisible line already for where it's at. But if we look here for where we put our support line and we actually draw one in, then it appears that we could possibly be seeing a bounce up from where the price currently is, just based on the fact that it has previous resistance points here, 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 and here. And then this goes into where it's supported on this line roughly 3 times since those different resistances have been broken. This is where you can start thinking about where you might want to buy in if you want to get into a safer position. But it's not always going to be this easy where you you can just guess where the stock is. These support lines are just kind of a basis of where it might be falling to. And so if we look into drawing resistances as well, this is all going to go into where you can see it bouncing in a channel. If we go about finding resistances, we can use the same logic where we've got a few resistance points down here on the bottom right, and then we've also got a support area that's trending right here where it peaked for a second and then went all the way back up before coming down this area, bounced off this major support, and then kind of sat up and down in volatility in this area here where we were looking at the new resistance as of now. So looking at the chart with these lines currently set up, this is going to be a place where you might want to put a resistance. You can really use any colors for this, anything you want. I usually just use yellow for support and red for resistance. It just makes it easier for me to see. The colors aren't really important, more so than just having the lines there for you to read out. Now that we've got this, it can seem very apparent that it usually has been residing in this channel for this period of the last 6 months. So when you're getting into a stock, these are going to be important for you to kind of check out and see where you might want to enter a position going in. I thought anything under $3 going into this month was great, especially because they have a catalyst coming up on the 27th where they're going to have trial data come out. Knowing that we are trending towards possibly hitting this bottom support and bouncing, I thought anything where you start a position under 3, average down and let it get down to that support before it bounces again is going to set you up for a possible good increase in profits when it does get towards that catalyst. And we'll go into the logistics of selling and different things like that in my next video. But basically, you'd be trimming your profits up and taking stuff out over time to cover your initial investment while you still have that low average. For a lot of people, having that lower average is going to be a make or break on their ability to get out of the trade faster and move their money around to different trades as well. So obviously, the lower your average is, the better when it does start going up, because you can start trimming those profits easier when it all starts coming together. So for the sake of this video, I'm going to put a green line here, basically saying like anything 3 or under, I want to buy for this position. Now we're going to use the logic, like I said, that we're using $100 in buy power before we go over to the whiteboard and kind of break down how my plan would be entering this trade. We're going to assume that we're buying into INFI at $3, for example, and we think this is a good buy area, but we know that there's potential for it to either go up or down from our current price. I'm going to be doing my initial buy-in at 5 to 10%, which if we're assuming $100 in buy power, it would put me about $10 worth of investing into the stock. This gives me a good solid area where no matter where the stock trends, I have a position, I have an anchor to buy down from or buy up from, so that if it goes down, I can easily influence that price down. Whereas if it goes up, I can still keep it in a way that if I'm doing small buys up, it keeps my average still pulled back a little bit from the current upward trend. No matter your account size, using percentages like this is how you're going to be able to translate better. But basically, going into any trade with a plan where you know the exact buy power you are willing to put towards a stock, or a rough range of buy power you're willing to do, you can start doing percentages to see where you might want to enter that position, so you're not setting yourself up to basically throw all your buy power in and give yourself no leverage to go up or down with the stock price. You can scale these percentages any way you'd like to, but I usually try to keep it where I scale it from the buy power I have left. So technically, I would do 15 to 20% of $90 once I put that initial buy-in. But for the sake of the video, we're just going to assume we're taking it fully from that $100 to make the math easier to follow. So if we're assuming the max end of the small price up or down movement, whether the price moves up from $3 and goes to like $3.10, or it goes down from $3 and hits like $2.90, $2.95, we're going to put 15 to 20% more of our buy power in, so that we can kind of leverage more into that average price that we're looking at. If we look at something that's a larger movement, usually I think this is going to be when a stock swings anywhere from 10 to 30% down or up on a trend. You're going to be looking at where you'd want to add in the largest amount of your position. Normally, I'm not going to add this amount on an upward trend unless it looks like it has severe upside, and this is going to be outside like scenarios, just extreme situations. But normally I don't want to add anything large like this, 25 to 30% of my buy power, if it's moving on an upward trend. I usually want to wait till it's consolidating or pulling back to put this larger movement amount in. That way I'm not overextending myself, and then that way I'm also allowing for a possible bottom out to where I can buy in a huge amount before it bounces. If we look at that, that would put us about $30, and as you can see from our math, we've got $60 in the stock, and we've still got $40 left to play with if we just had an initial buy-in, a small movement, and then a larger price movement. Obviously, this isn't going to be clean cut like that. Sometimes you won't even get those large price movements, and you'll just just be adding a bunch of smaller price movements as we go on with the stock price. But this kind of sets you up for a little better hedging of your position to where you can get your price in a more comfortable position. So even if there's a large pullback or something like that, you're not having too much emotion in it because your percents aren't going to be down too much. You'll be down like 1 to 2% if you're following the trend correctly. Now, as we look at the breakdown of both how many shares you would have and what your average would be if we were going all in versus dollar cost averaging on INFI at this current time, we can hypothesize some averages based on my methods. So say I wanted to buy in at $3, but I'm just going to say, screw it. I'm going to put in all of my buy power. You'll get 39 shares, which will get you a decent amount of shares, but you're stuck at $3 and you don't really have room to maneuver. So you're going to have to hope that goes over $3. And if it trades sideways or doesn't react to our catalyst as we expect, then you might be deep underwater, especially with it popping down to the 2.56 area now. The next way we're looking at it is if you were to dollar cost average at the 3.0 price, you'd have had about 3.3 shares. At the 2.9 price, you'd have had 6.9 shares. And then say you want to buy around 2.6, but this time use your large price movement, you're going to get 11.5 shares. Now, obviously the numbers aren't going to be exactly on dot, but I was going to carry it out like 7 decimals. So give or take like a couple pennies and stuff here and there, you've got about 21.7 shares and an average of about 2.75 to 2.76. Personally, for me, I'm going to go for, even though I have less shares, I'm going to be going for that lower average, especially because when it swings up, it'll kind of offset that anyway with the amount you'll get. So now when we look at what you could be making in profits, if this catalyst goes off and this rises over $3, you're more likely to make more money off of even these 21.7 shares going up above $3 than you would at the 39 shares going up above $3. Now, as we look at a stock like CCXI, where it has possible volatility based on different events going on, we can see it has some erratic movements sometimes, like in this pre-market session where it just ripped and was at not even an hour before about $13, and it hit a peak up of about $18.23 during this time. So that's a $3 difference. And if you're watching this, you're probably going to be like, well, how do I even remotely judge what's going on here? And this is why indicators like RSI or your relative strength index come into play. Specifically on TradingView, I'll use a volume weighted average price RSI, but we're just going to use the basic one because most platforms won't have that. And so if we're looking at RSI based on the previous closing price, you can see during that spike, it's severely overbought. Like we're talking about almost 100, and anything over 70 is usually way too high and is looking to pull back. And that reflected here where it pulled back and came down and bounced down even into the oversold range at the end and kind of stayed back towards the middle. And even once it got back even, it stayed above this older price it was before this big spike. Now, a lot of people would say, well, how would I use RSI to my advantage? And this is where this helps to know some basic charting, even without drawing your support and resistance lines, because you can see a scenario like this where you want to get an average in. And this is where it helps to know what a company is doing with fundamentals, because the reason this spiked was due to the fact that they added new stuff to their file for possible FDA approval, and that's now getting delayed until October. And if we look towards October, we could see there's a gap here that's kind of missing where we could be seeing a rise now between $24 and $26, which is why I think they have a lot more upside and why I might want to buy in around this volatility at the time if I don't have a position. So now as we're looking at this chart, we're going to be figuring out, well, I don't have a position, where should I enter? So a usually good sign to see where it could be falling, especially on a 1-minute chart during intraday with huge volatility on this, is seeing where it's starting to settle either around the middle or turning more towards oversold. Once it gets to one of those areas, it's more likely getting to a point where it's going to bottom out and possibly rebound back to where it is. If you want to also go with your hunch on using another indicator to go with this, you can use a VWAP. Most platforms are just going to have the one line. So this blue line is what you're going to be looking for. And we can see that when it got sold off, even with the RSI showing here and it's staying around the middle, you can see it's significantly below the VWAP. And normally that's a sign that we could be seeing pullback towards that VWAP again. And so that's why you don't want to rely on one indicator, because usually you can see confirmation if you use one or more on top of everything else. So as I see it below the VWAP and I see it bottoming out in this area, I could possibly be adding a position here as it trends under $15, because I see that it was only around $13.50 here anyway before. And this seems like it might hold in this area considering it's already under the VWAP. If we add a position here, we're not too overextended because we're not buying when it's overbought or ran too much. And then we're also giving it a bit of time to settle down. As it rebounds back in, we could see that it's bottoming out around a consolidation here of roughly just at $14 or under. And that would be possibly where we would add our next position on CCXI. Normally, since that's not too much of a crazy drop, that would be where you would add your next 10 to 15% average. You can add another 10 to 15% average here. If you're looking to do a short-term trade, you can even look for more pullback here when it goes. And then your average is probably going to be slightly below or just at this line that it's trending. And then as you look into the next few days, you obviously have a few different opportunities to take a dip. If you can do pre-market or after hours trading, you have a possibility of getting under 14. This is where if it drops this much, this is where I'm adding my 30%, or even here, I would be adding my 30% in. And then as you get up to here where it ran to 18 again, you are in a solid spot where you just made about $4 a share because you were smart. You didn't trace this and buy here, and you weren't sitting red for multiple days stressing about whether you should cut your position or possibly already cutting your position because you feel like you're overextended. So that's why these percentages can even work in a volatile setting, because they can help you where you're not sure if it's a falling knife or if it's starting to bottom out. You can get at least a position in case it runs again. And if it does run again and it just goes stupid high, you know, cool, you made a couple bucks. You're not doing anything crazy, but you still made some profit. If it does pull back more, then you can use some more of that buy power that you have left over to go in. Usually I look to see to make sure out of my entire portfolio, I have some cash on hand. You don't usually want to have 100% utilization of your assets. So even in individual stocks, I'll look to portray that so that I have leeway in each individual stock. And then if I have very high conviction in something going on, I can obviously pull from something else that I don't need as much buy power in, and you can kind of rotate that stuff around. I really just wanted to get into a series to help you guys out with even just basic fundamentals of charting to get you started and put on the right path, as well as setting you up to get yourself positioned better in future trades. My next videos in the series are going to focus around selling and how to trim going up to retain profits and possibly buy back in on dips. And then the further ones out are going to be some more advanced charting techniques that I use to kind of confirm certain trends or see where we could be looking at possible different reversals and things as we look at stuff in real time and in high volatility. I'll be looking to get more of that content out here over the next week or two so you guys are set up for your future trades as soon as possible. I know a lot of people, especially going into the next month or two, are probably overextended as it is already on some of their positions. And I am assuming we are going to be coming up on a market correction with some of the COVID stuff that's ramping up with some of the data, and the fact that NASDAQ has been trending upwards for a while now and is basically due for a shelf pullback from where it was previously sitting on a support. So other than that, that's going to do it for me in this video today, guys, and I'll catch you in the next one. Peace.